Welcome back from our break. It's now my pleasure to introduce Sophie Flack, Managing Partner for CSR and Digital at Eurazeo, Bertrand Merlot, Vice President, Risk Management, Fixed Income, and Head of Climate Risk and Issues at CDPQ, Jaideep Das, Partner Global M&A Advisory Lead and Regional Client Director for Finance at ERM, Megan Starr, Global Head of Impact for the Carlyle Group, and Dazzle Bujwala, Director of the Investor Network for Ceres, who will highlight how pension funds can incorporate climate risks and opportunities in private equity investments to meet fund-level net zero emissions ambition, and how private equity managers can move from managing a one-off impact portfolio to incorporating a firm-wide climate and sustainability framework. Let's get started.
Thank you, Dawn, and hello, everyone. Before we dive into today's conversation, let me lay the context for why we are talking about private equity and what role this asset class can play as the world transitions towards the net zero economy. It is no surprise that climate change has become one of the top priorities for governments, companies, and investors around the world. And with a growing number of net zero commitments, there is a keen interest among institutional investors to reduce emissions both from the portfolios and from the real economy as they strive to achieve the desired financial returns. For investors to achieve net zero commitment, they will have to decarbonize their entire portfolio and reduce emissions across all asset classes. One asset class that has seen an impressive growth in asset allocation in almost every institutional portfolio over the past decade is private equity. And this allocation is likely to increase in the coming years. But when it comes to integrating ESG and climate in private equity investments, there is more work to be done. So from the perspective of reducing emissions from portfolios and meeting net zero commitments, investors cannot ignore private equity investments. And when it comes to reducing emissions from the real economy, private equity is one asset class that offers investable, scalable, and impactful climate solutions across all carbon-intensive sectors, and also helps create a pipeline of climate-focused companies ready to go public. So focusing on this asset class is paramount, both from risk and return perspective, and that's what we are going to focus on today's discussion. The experts right here will highlight what goes behind setting robust net zero strategies for private equity investments and share best practices in governance, risk management, value creation, and more. So without any further delay, let's get started. Jaideep, let's start with you in terms of the current climate landscape for private markets. We know that disruption in ESG and climate trends is creating significant opportunities for sophisticated investors. How do you see this evolving in private markets?
Sure. First of all, thank you, Dazzle, and hello, everyone. It's a real pleasure to join this panel today. The Sustainability Institute by ERM is delighted to have partnered with Ceres to look at this really important project in terms of understanding what are the key motivators, the key challenges, as well as, very importantly, what investment opportunities facing the private equity kind of sector in relation to climate change and what we term as the low carbon economy transition. And I'm happy to obviously share my kind of observations from the work that we've done with clients, but also during the research where we engage with a range of leading asset owners and asset managers, including some of the fellow panelists who are here today, with a real view to understanding what does good look like and sharing that good practice across the sector. So some of the actual report will come out in late May, but I'm happy to share some of the kind of preliminary kind of observations. So first of all, I'd like to just highlight there's increasing recognition that climate change is an emergency and it needs global action from all facets of the society, including the financial ecosystem and all actors within that. We certainly believe and have seen that COVID has accelerated the focus on climate change and its view as a systemic risk. But we also know that the business as usual, including the promises made by countries in Paris, is unlikely to lead us to a 1.5 degree world that we're striving for. So what we are really looking at is a COVID-like CO2 reduction, which was around a 7% figure globally, every year leading up to 2050 to achieve a net zero ambition. But obviously, everyone wants to avoid the economic and social kind of impact that we have seen over the last 12 months. So what the point I'm trying to make is this is not a gradual change, but more a system reboot model. And you talked about the PE operating model, and we definitely believe with its sort of high level of influence in company boards, it's really well placed to support underlying investee companies and not only becoming resilient to this transformation that is underway, but also provide capital towards deploying products and services at scale and at pace that contribute to solutions to this global challenge and create value for all stakeholders. So it's very much an investment play and not just an investment and an emission reductions play for us. The second thing is, there's definitely been much more momentum and action within the private equity space, particularly over the last 18 to 24 months. And I know some on this call have been working on this topic for much longer than this. But net zero kind of and climate change response, I would still characterize it as being polarized in the industry. By that, what I mean is you have a clear group of leaders who are doing a lot, and I'll share some examples. But there's also a majority still at a very early stage. So the leaders, we see them really looking at their own investment strategies and how they engage with companies, really invest behind this big mega trend. But, one interesting thing is, there's a greater attention we see more on the transition side than the physical risk side, perhaps because the physical risk is seen as a much more longer term issue. But that's an interesting thing that we've seen so far. The level of sort of net zero commitments is still on the lower side, but we expect it to change both from asset owners and asset managers going forward. But as I said, as broadly beyond the leaders, it's still very much at a nascent stage, and the industry is really crying out what we see for more alignment on standards, how consistency in the way climate change is reported in data, tools that are deployed, and metrics, etc. But also the engagement between LPs and GPs, so that majority of the time is spent in implementing actions and accessing the opportunities and managing the risk. So that's where at a high level where we see where the broad sort of market is in terms of its response to climate change and low carbon energy transition.
Thanks, Jaideep. So it's very clear from your comments that the interest and momentum is there, but still there is much more work to be done. Investors, especially GPs, are thinking about net zero, but yet not there in terms of making those kind of commitments. Sophie, let me turn it to you because Eurazeo is the first private equity firm that has actually gone ahead and made the net zero commitment to reduce emissions from your portfolio by 2040. Can you explain to us why you made this commitment and what is your strategy to achieve this commitment by 2040?
Sure. First of all, hello, everybody, and thank you, Dazzle, for this invitation. And I'm very happy to be able to share why we took this decision and how we are working to deliver it. Because as Jaideep said, there is some momentum. But as you also very well said, Dazzle, not enough yet. So how do we make sure we convince other fellow colleagues together? First of all, I would just like very briefly to explain what does it mean making a net zero commitment. So when you are a private equity company, it applies, of course, to your portfolio to some extent that you need to define, but it also applies to ourselves. So us, as an investment company, we will also need to become net zero. And for me, there is definitely a very big difference between saying, hey guys, I'm going to be net zero, and picking out probably one of the most demanding methodology, scientifically recognized worldwide, which is the Science-Based Target Initiative methodology, and which is the one we have chosen. This methodology is based on scientific knowledge that has been developed for the COP21. So the Paris Accord, what does it say? Becoming carbon net neutral, what does it mean? It means this budget, you need to decrease to this much to be able to try to keep the rise of temperature below 2 degrees. And what does it mean for a company? And you will very well understand that it was not an easy decision, and it was definitely not taken overnight. It is the achievement of nearly 20 years of working in ESG at Eurazeo, testing, making sure we could achieve it and understand what it means. So it means that for a company, notwithstanding its growth, the carbon budget will reduce. So for example, at Eurazeo, we are a very dynamic company with a very strong growing pace. Our budget is this much. We will need to decrease it by 80% by 2040, even if we double size in terms of employees. Okay, so you understand there is really the question of how are you going to decorrelate economic development, economic performance, economic growth, and environmental footprint. And this is definitely what is at the issue here. So now how are we going to do it? First of all, as I said, it is a result of a process. So over the last 20 years, we've been working not only on Eurazeo perimeter, and we believe it's important because we need to lead by example, and we also learn a lot when we apply such demanding methodologies to ourselves, but also with our portfolio. And as a matter of fact, and I'm maybe going to tell you a little bit of a story, a few years ago, we did an investment in a very heavy emitting company. So we're in France, we're in Europe, you know that we have a carbon market and some companies need to pay carbon quotas. And when we did the investment 5 years ago, we did for the first time, working hand in hand with the investment team, some carbon stress test on the business model of the company. And we were working on what if. When we did the acquisition, the price of 1 carbon ton was €8 per ton. Today, the price is over €40. Never we would have imagined it would go so fast. So you very well understand the direct impact on the performance of the company. And so as a matter of fact, we've taken a very, sorry, I'm looking for my words in English, but we are very strongly committed to decarbonize. And so far we've achieved 30% of decarbonization. So we've decreased the carbon footprint by 30% by product diversification, by circular economy process implementation, by huge energy saving programs, and also changing the energy mix. And what we are seeing is that if we hadn't done anything, the direct impact on the EBITDA would be we would be nearly reaching the dozen of millions of euros. So this is absolutely massive. And decarbonizing is not easy. It costs money, it takes time, so you need to start early. So you understand that our commitment comes from this knowledge. We are confident now that we can deliver, and that's very much Eurazeo's culture. You know, when we take stands, we are sure we can deliver. And also there is a very strong strategic thinking at play. We want to make sure we will not have stranded assets in our portfolios. But also, we want to be a responsible investor.
Great. Sophie, I'm going to pick up from the, it's an emergency. Let me turn it over to Bertrand, understanding the real risk management, at an LP level. Bertrand, the CDPQ announced its net zero commitment in 2019 as the founding member, of Net Zero Asset Owner Alliance. Please share some, or throw some light in terms of how CDPQ is identifying and mitigating climate risk within its private equity investments. And I also have a follow-up question, if you could quickly address that as well, in terms of, are the investment teams held accountable for managing or not managing climate risk?
Thank you, Dazzle, and good morning, everybody. Just a brief recap on CDPQ. We're a pension plan, $364 billion Canadian under management, about 65 in private equity, and about 30 in infrastructure. I'll speak about infrastructure because it's a key component. When I say infrastructure, it's invested in private equity type transactions in the infrastructure sector. So we did commit to net zero in 2019, but we already announced climate targets and very strong commitments with regards to climate at the end of 2017. So we've been in the game for quite some time now with results to show. The energy transition is a very, very important, very key thing in investment. First and foremost, because of the opportunities that we see. So we invest a lot in green power, in issues like electrified transport, public transport, energy efficiency, companies that are working towards transitions. And I may have time to give a few examples at the end. So that's one thing, benefiting from these opportunities. From the risk management, we are very conscious of the issues that face the high emitting sectors, but not only these. And so we have generally at CDPQ, a centralized risk management process where the risk department is represented among all the asset classes. All investments go through a process of two-step approval. Risk is involved in the approval of these investments. And so that fosters the dialogue on risk and on climate risk in particular. The way we look at transition risk is mostly through a qualitative approach. It is very, very difficult to quantify transition risk at the portfolio level. However, at the asset level, it becomes a little bit more easier once you understand what the company you're proposing to invest in is doing and how changing government policies, changing carbon price, etc., might impact its business. So that is being taken into account at the time of the investment decision. And if the risk is perceived to be high, then we would hire experts to go over it, to look at scenarios of where the economy might be moving and what that might mean for the company and for the returns. With regards to physical risk, we are in the process of adopting a tool which we procured with other Canadian asset owners to help us measure the physical risks in a more scientific fashion. And so that will be rolled out over the next 2 years within the organizations. So that's in a quick summary. Risks doesn't mean one does not need to invest or must not invest, but you need to do so in full knowledge. And there are, and it's important also to remember that decarbonizing portfolios on the planet doesn't necessarily mean getting rid of all carbon heavy assets. On the contrary, one needs to remain invested in them and work with them for themselves to decarbonize. Shifting assets to another portfolio does not decarbonize the planet. And so this is the type of things that we do internally once we have invested and engage with companies and make sure that they are putting in place processes to decarbonize their investment. So we are an active investor in that context. With regards to, we take all this very, very seriously, and I'll answer your last question, Dazzle. We implemented, as part of our climate strategy in 2017, a direct link between carbon and compensation, variable compensation of teams. And so each investment team, including the private equity asset class, has been allocated a carbon budget, and their compensation is directly impacted in a quite material fashion on the downside if the targets that have been set are not met. So, and let me tell you, this is very effective in finance. It gets people's attention and delivers results. Thank you.
Perfect. Megan, let's get to you in terms of understanding the governance practices at Carlyle. Purpose and transparency is becoming an increasingly important issue in a growing ESG world. So if you could throw some quick light, on the governance practices at Carlyle.
Thanks for having me, Dazzle, and thanks to Ceres. I want to echo what Sophie touched on a little bit, which is that climate change and the energy transition isn't a story for 1% of our AUM. It's not a climate change product or a small sliver of our total investment portfolio. It's relevant across the portfolio. And that's why we really thought about it as change over time, because the transition is just that, it's a transition. And so I think sometimes this field can get caught up in this artificial binary of good companies and bad companies as it relates to climate. And I think the interesting story is, where do you drive financial value by helping companies along this energy transition? So from a governance perspective, it starts at the top. And so I report directly into our board of directors, and Carlyle is a public company. Actually just did our report last week, and climate risk is one of the things that we talk about there. We also published our first TCFD report this past year, the Task Force on Climate-Related Financial Disclosures, because we all have framework fatigue, but TCFD is really one of the areas where we see convergence in the field around saying this is best practice for reporting climate risk in return. And then when we think about managing across our portfolio, I kind of think about our governance approach in 3 buckets. So first, how do we mitigate and reduce left tail risk? That looks like avoiding sectors that are fundamentally misaligned with a changing future. And we all know what those are: coal mining, coal-fired power plants, et cetera. It also means being thoughtful about doing things like pricing sensitivities for carbon price as we're diligencing investments. Bertrand, I would love to talk to you about the physical risk tool, because we've started looking at physical risks when we're underwriting potential investments. Last year, we were looking at a portfolio of coastal real estate and worked with a climate risk consultant for the first time to start pricing in things like sea level rise and extreme weather related events, and importantly, insurability. And so this idea of how do we better mitigate and really cut off that left tail risk, because we think there's the potential for material market dislocations as we make this transition. The bucket on the other side is, how do you double down on right tail upside? There is a lot of growth in this space. We launched a renewable and sustainable energy platform 2 years ago under the leadership of Puja Goyal, and we're deploying capital into the sectors that we think are really going to benefit. That's both renewables, but we're also investing in traditional companies who are shifting their business models. For example, an investment of ours was in a company called Axle Tech, made conventional drivetrain technology for heavy-duty commercial vehicles. We invested an additional $20 million in designing and prototyping and rolling out in-axle electric powertrains. And that ended up being the real growth driver upon exit for that company. And so again, this idea of where is the market going and how do you capture that upside? And then the middle bucket is, how do we better manage risks and opportunities across the rest of our portfolio? We did a bottoms-up carbon footprint of our majority-owned companies in our 3 primary private equity funds this past year. And importantly, the carbon emissions footprint wasn't the answer. It didn't tell us if those were good companies or bad companies. It was an input into how we could better manage them and prepare them for that changing world. So that's a brief tour de force of how we think about the kind of governance and transparency piece, but I would just emphasize that we really do see this as a transition, and we see it relevant across the $246 billion in assets we manage, not just for a sliver that might be considered impact.
It clearly shows that all 4 of you are so passionate about the work that you are in, and there's so much to add, but we are running short of time. So what I'm going to do is, I'm going to switch the gears over here and get into a lightning round questions. Bertrand, let me talk to you about manager selection and expectations. Since you have set the net zero targets, has CDP's Q expectation changed from their managers, and what are you expecting from your managers now?
Absolutely, it has. We expect managers to take climate change into consideration during the investment decisions in order to benefit from opportunities and manage the risks. And we ask them how they do that. We would also ask them to implement restrictions that we impose on ourselves with regards to a number of sectors and businesses that we want to invest in from a climate change point of view. And if possible, and I know it's tricky, we expect reporting on carbon footprint, but reporting generally from the companies. And that's generally one issue in private equity, which we find even for the investments that we own directly, is people need to start reporting and taking the TCFD seriously in private equity. Thank you.
Perfect. Megan, let's talk about value creation in a world of voluntary disclosure and reporting. It's important to have actionable data. How is Carlyle engaging their portfolio companies and reporting it back to their LPs?
I think sometimes there's an argument in our field between broad-based metrics that are comparable across a wide range of companies and then bespoke material metrics tied to a specific industry. And our answer is simply, we think you need both. And what we've seen is that data can really help us drive better investment decisions. One quick example, we've done a few ESG-linked financings for our portfolio companies recently, where we're able to link the price of their debt to hitting environmental targets such as carbon emissions reductions or water reductions. It's a great way of saying that's a more efficient business model, but we're finding additional tools of private equity investing to incentivize that convergence between profitability and climate impact.
Perfect. Sophie, one of the bigger questions that we hear when we engage with GPs is that they are still at an early stage of setting net zero targets. It's primarily the nature of the life cycle of private equity investments. If they don't know what they are going to be invested in 2030 and 2040, how can they set net zero targets today? What would you have to say to those GPs?
Well, of course, they're pointing out to a very real concern, because we know that our portfolio are moving. At Eurazeo, we have more than 500 companies and it constantly moves. And also we have very varying level depending on the investment strategy. Private equity, direct equity is pretty different from debt or private fund. So of course we won't have the same levels on the company. Nevertheless, we believe it is going to be mainstream. Decarbonization is going to become an absolute must-have. Depending in the region of the world, tax and regulations are going to take place very fast, so we need companies to get ready. And going through a net zero decarbonization pathway is the way to get ready. Yet, let's not worry about what it means. The discussion we have with the Science Based Targets initiative about what is a commitment for the portfolio is a significant percentage of the AUM under management to commit to have an SBTi decarbonization pathway. So depending on the heavy emitting or lower emitting companies, you might have less or more assets committing. And committing doesn't mean an end date. Each company is going to set its own piece of, its own timeline to decarbonize. Us, as a shareholder, our role is to make sure that our most emitting companies are committing fast with science-based targets.
Perfect. Jaideep, do you have any comments in terms of how LPs and GPs should be looking at their net zero ambitions going forward? Any final words from your side?
So I think we've heard the GPs and LPs today on the panel and others when we interview. Some great examples out there how people are tackling this complex topic. It can seem daunting, embarking on by 2030. We are looking at a 50 to 60% emission reduction across the globe, generally to meet the net zero kind of target. It can seem quite daunting as a topic, but we've seen some practical steps that LPs and GPs are taking, and I think there's a lot of good practice that can be shared and adopted. It's certainly it's an existential risk, but it's also a once in a lifetime opportunity to create value. So by helping companies decarbonize and invest behind solutions, so we're seeing a lot of PE funds and infrastructure funds, look at hydrogen opportunities, electrification opportunities, or how do you help industrial businesses to decarbonize? So there's some significant opportunities there for the taking as well. And I think, in our opinion, a compliance mindset is not going to get us there. This is a transformation challenge. So I think what we're really looking for companies to do is adopt best practices, both, thinking about diligence, so providing capital expenditure or additional OPEX, not just for compliance, but for transformation. That's the kind of mindset. And that's a shift in the way we've looked at ESG in the past. I think climate change really focuses attention and time of all the fund managers and their advisors to kind of look at this particular aspect, as well as helping companies become strong, become more resilient so that they can get that value at exit. So I think there's a great opportunity and story there. And PE, they've always prided themselves on doing improvements at pace and scale. And now we have a fantastic opportunity on the world's most complex problems for PE to take leadership. So I think that's really exciting.
Absolutely. On that important note, I'm going to conclude this session. But before we conclude, I'm just going to highlight two great resources for investors. Number one, investors, both LPs and GPs, should look forward to joining Ceres' private equity working group, where we'll be addressing many of the open questions that we have discussed today. and support LPs and GPs to really help frame their net zero framework and set net zero targets and ambitions going forward. And number two, look out for Ceres ERM report on the changing climate for private equity, which will be released in the second half of May. With this, thank you very much to our speakers, and thank you to our audience.